A stay at a Hilton hotel, a trip to Legoland, and a personal DNA test kit are all products of different industries, yet they share a single owner, the private equity firm Blackstone. We are going to reverse engineer how these firms operate by building a private equity deal map. This isn't about memorizing definitions. It's about tracing the specific mechanics that allow these firms to acquire and transform global brands. To follow along, open a note-taking app or grab a piece of paper. Pick a brand you use frequently. We'll use it to reveal the financial logic behind its corporate decisions. Building this map shifts your perspective from that of a consumer to that of an analyst, revealing the incentives that dictate how these companies actually function. For step 1, create the first block on your map. Write down your target asset. For this example, we'll use Hilton Hotels, and draw a line connecting it to its parent owner, Blackstone. Unlike a traditional family business that might hold an asset for generations, a private equity firm acts as a temporary, well-funded renovator. They buy a company with the explicit intent to overhaul its operations. Identifying the owner is the baseline for your map. While this link doesn't explain everything yet, it provides the necessary context for the aggressive operational changes we will account for in the next steps. Step 2 is to add a strategy classification section. Most private equity deals fall into one of 4 categories: leveraged buyout, growth, venture capital, or distressed investing. A leveraged buyout involves purchasing a mature company using significant amounts of debt. Growth equity is different. The firm takes a smaller stake in a healthy company to provide the cash needed for a specific expansion. Then there is venture capital, which targets young startups with high failure rates but massive potential. This specific strategy is what launched the modern private equity industry following World War II. In 1946, Georges Doriot founded ARDC, the first venture firm. He invested $70,000 into a startup, an investment that grew to $355 million by 1968. That return came from Digital Equipment Corporation, the company that pioneered the interactive mini-computer. Categorizing the flavor of your deal on the map is essential. It immediately signals the firm's timeline and how much risk they are willing to take with the brand. For step 3, draw a horizontal pipeline: raise, buy, boost, and exit. In the raise phase, firms collect capital, introducing a standard fee structure, a 2% management fee, and 20% of profits. After buying and restructuring, the firm hits exit. A 5 to 10-year clock forces them to sell or go public to fulfill obligations. Mapping this pipeline demonstrates that private equity isn't about long-term stewardship. It is a high-pressure, temporary ownership model designed for a rapid turnaround. The final section of your map is the financial result. Here, we calculate the primary engine of the leveraged buyout: debt leverage. This chart represents a $100 million acquisition. The firm contributes $30 million in cash, borrowing $70 million secured by the company's assets. If they double the valuation to $200 million and sell, they repay the $70 million loan, leaving $130 million, quadrupling their initial cash. On your map, record the Blackstone Hilton deal as a success. Blackstone bought Hilton for $26 billion in 2007. Despite a global recession, they streamlined the business and exited in 2013 with a $14 billion profit. Now, record a failure: Toys R Us. In 2005, private equity firms saddled the retailer with over $6 billion in debt. The interest payments alone prevented the company from competing with online retailers, leading to its 2017 bankruptcy. This shows that leverage is a neutral tool. Depending on the execution and market conditions, it can either generate massive wealth or lead to total corporate collapse. Review your finished deal map. You have tracked the owner, classified the strategy, plotted the life cycle, and calculated the leverage mechanics. These 4 sections replace the vague marketing of a brand with a clear mathematical framework. You can now see the specific financial pressures that drive why companies merge, cut costs, or shut down. Use this framework whenever you see a major corporate shakeup. Look at the industries you work in or the brands you buy from, and identify which stage of the map they are currently in. Understanding these mechanics changes how you perceive every headline about a merger or a store closure. It turns the complex world of finance into a series of predictable, strategic moves.